welcome back to this channel. Now in today's video we are going to look at what is true order flow or just high probability order flow. So what I want you to note is that it is from the order flow that we derive order block and we derive fair value gap. So just know that in most occasion it is order flow that works and not really order block and fair value gap. So order flow is just a trading concept that involves analyzing the actual buy and sell orders in the market to understand where price is likely to go. So by observing the flow of orders, you can gain insight into the supply and demand dynamics, allowing you to predict potential price movement more accurately, as I'm going to demonstrate using this chart you are seeing, and then we will go to the market and demonstrate from higher time frame and possibly from a lower time frame if the video is not that long. So what you need to know is that true order flow entails you understanding the market dynamics such that you are able to anticipate where the big players, institutions, bank, hedge funds are likely to be placing their orders. Now if you check here, if you check in this diagram, this is the flow of how orders flew in a bullish market, and then it came to a bearish market. So basically order flow looks like this in real life. This is how order flow looks. As you can see, the market moved upward and then downwards and then changed the character somewhere here, pulled back, moved, pulled back, moved in that way. So if it is consolidating, you can see the way it is consolidating here. Here it can be also consolidating. So this is the real life order flow, not the one we always think of, because these ones are made from order book which contain prices of bid and ask at the same time. So people, hedge funds and big financial institutions look at this and know exactly where to buy and where to sell. And as you can see, candles are drawn from this order book in, like, let's say in a certain time frame. If in a certain time frame you will find this, and then within a certain time frame is if buys are more, you will see blue candle being printed or a buy candle. Then when orders start to sell, when there are more sellers than buyer in the order book, a red candle is printed. So basically that is how order flow works. You can see this one is an example of a heat map or volume profile, where you can use to get like this point of control line where there is a lot of resistance. It means that when price comes there, most likely they are going to be buyers. Now if you look at hedge fund softwares or computers, you will see them operating something like this and not necessarily the candles, because they want to see the actual order flow in the market and know where to buy and where to ask to avoid losing their money. So let's get back to chart. What I want you to know is that true order flow is always the king of the market, and the market only follows orders in order book that I've shown you. So the market moves where there are orders. If there are more sellers, the market sells, like in this case. In this case, this order book shows that there were more sellers because of these red candles. Then this next order book shows that there were more buyers, and that is how the market moves. It moves where there is orders, and orders need to flow concurrently, both buys and sells. So whichever outweighs the other is what is moving and breaking structures. Now in this case, I want you to note that there are characteristics of high probability true order flow, and that conditions are as follow. Number one, a true order flow must have a proper break of structure, as I've shown here. Then, so that's the first thing to look at. Then it should be located at premium or discount zone, that is above 50% of the whole break of structure leg. And then it must have clear fair value gap and order block, so that you can get precision entry. At the same time, you provide enough room for pullback. Now the second last characteristic is that it must have retraced choppily or efficiently. So if the market is efficient, it means it's ranging while pulling back. It's ranging a lot. So if it is choppy that way, when it is approaching the order flow zone where there is fair value gap and order block, the market will rapidly move, as I will show in the actual chart. Now the break of structure leg must have structural liquidity. Structural liquidity are basically IDMs and engineered liquidity. If you want to know exactly how proper or high probability or true of this particular techniques, just search in the channel here, and you're going to see a proper break of structure, a proper fair value gap, and a valid order block, and so on and so forth, like these liquidities. Now with that said, let's analyze this chart. So when you look at this chart, you'll see that the market came here, pulled back, tapped onto some order flow over here, and then broke structure. Now if you check the last cell, the last cell before this buy move that causes a break of structure, that is what is referred to as order flow. This is the last cell before the buy, so you mark it like that. If the market comes to it, market will target areas where there is this characteristic that I've said here, especially on premium and discount and clear fair value and order block. So you can react to either fair value within the order flow or order block within the order flow. So when it retraces like this, it should be choppy. Then when it comes here, taps onto some order block inside this fair value gap, it should automatically rally to the upside and cause a break of structure. Now, and then you follow the next order flow is this is the last cell before the buy. This becomes the order flow. So let's delete this one so that we avoid cluttering. So this order flow has already been mitigated, and therefore it does not work anymore. So this one is already mitigated. Now in most occasions, if you see something happening like this where order flow was tapped and it was raided, there are two options on why the market will do that. Number one, there was no structural liquidity here. Number two, this market came impulsively, very inefficient. That is why it lacked a lot of liquidity pools in this leg. So that is why it will chop, it will kiss or pierce this area, which is not change of character but rather a sweep of liquidity or IDM, and immediately cause a break of structure. So such kind of market movement is always high probability when market comes to it, because this would be the next break order flow. So when you mark an order flow like this, you can even narrow it down to another order flow, maybe somewhere here that took this liquidity. You can always narrow it down here. So when the market taps onto it, this is the actual order flow, but now there is some order flow inside it. So when market taps to it, it should rally upward immediately, causing internal change of character or eye choke. So when this internal change of character is confirmed that the market is going to be breaking this structure here. So even if you see a pullback, especially if this happened at night, a pullback will be somewhere here. So you need to just continue waiting for another change of character in lower time frame, and then you can buy from that point. So let's continue analyzing this. So you can see this is now an example of what I was saying, whereby we have this last cell leg before the buy, and within it you can also have another refined cell before the buy. If you are trading supply and demand, you will know that this is now a base, a rally, then a retracement, then a rally. So it is sort of order block following demand and supply. So when market taps into this eventual innermost order flow, it will tap. You will be waiting for somewhere here to come and tap on your order block, and then it does not happen like that. So that is why you need to be following order flow. Order flow does not lie. Now again, the market breaks structure here. The market pulls back, breaks structure. So this last sell before the buy becomes our another order flow. Now, what did I say about it? They are always liquidated if they didn't have structural liquidity, or if this leg here is moving rapidly, leaving fair value gaps. Most likely this low is going to be taken before the market taps onto these. Maybe there's another one here, there's another demand somewhere here. So the market taps onto it, and then it moves. So there could be some POI over there, and then the market moves. Now after that, the market now takes another, taps on this last before changing character. This is the last order flow. Then it breaks structure, and then it changes character over here. After tapping this order flow, you just need to keep buying until you are wrong. So market moves, gives you some few pips, and then it drops down. So dropping down, causing this may be exactly change of character. And how do you confirm change of character? When second break happens. Let me repeat. The first one could be liquidity sweep, and then we cause a break of structure. Don't get it twisted. Just know that the only thing that confirms that this is truly change of character is when we have the second break of structure, which is here. That is why some people call this just a sweep, and this is change of character. Sorry for that. So when this breaks, there is high probability that this market is going to continue selling. So what happens in that case? So we turn to now order flow that is now moving on the downside. So this leg here is the last buy before a drop. So we wait for the market to pull in it, take structural liquidity. These are pullbacks within this break of structure or change of character leg. So when it takes liquidity, we look for sells. Now again, there was another one here. There was this order flow. So some people try here. You can always try here, by the way, especially if this IDM is above 50%. Why am I saying so? It's because the market is always imperfect. So if it is above 50% of the range or the dealing range, you can always try it, and then if it fails, well and good, you wait for another confirmation just above this, and then you can go again. Now after that break of structure, this becomes our high probability order flow. Now again, the market taps on it, flies back. In this occasion, why is it always rapid? The third one is always rapid, or it causes eventually changes character here. The reason is because there is so many confirmation indicating that this market is going to go down. So that is why it is most likely going to tap it and then move. The other reason could be if this price leg here, was so efficient, which means that there were lots of pullback in it, and then a push, pullback, push, pullback, push. Sorry for that freezing, but I hope you can see so that we continue. So if this leg was so much efficient, the market may find only structural liquidity somewhere at this point. That is why it is also important to note that inside this price leg there could be pullbacks in it. So those pullback, if they are pulling back 50%, just know that the next one may not be this one may be the last pullback. Then maybe the market may take it and then drop down. So always learn to also know the pullback on how this main leg moved, and then market taps it, breaks structure. Then this is the market. Now this is the market order flow. So when market taps on it, it fails, most probably because of the reasons I said, but it takes this, and then another reason is this thing is less than 50% of the range. As you can see, it is less than 50%. So even if even if it moved the market last time, I wouldn't take this because it is clearly in the chop zone. Slaughterhouse. Slaughterhouses are areas in the market where there was pullback below the PDRA that you're below or above the PDRA you want to use. So if the market pulled back less than 50%, this automatically becomes what is called structural liquidity, and therefore you can just sit on your hands. Whether it will react from it and give a break of structure, do not regret, because in most occasions it will be taken out before the market drops. So if it is taken out and the market taps onto above 50% of the overall leg, we look for confirmation here and keep selling. Again, the market now breaks structure. So this whole leg here, this last buy before sell becomes our order block. So you can refine it to somewhere here, and then I said the market should be coming back choppily so that it can provide you with something like a pattern, like some head and shoulder, some wedges, especially ascending wedges if it is on if you are expecting sales. So, and wedges always in most occasion taps 1 2 3 and then it drops. So up here you should also be looking for fair value gaps and order blocks, and that is what makes a good high probability order flow. Let's go to the market and see if we can find some examples based on the thumbnail you just saw. So this is 4 hours. The market is moving down. You can see the market moved down, caused a break of structure. Market moved, caused break of structure. After breaking structure, we are waiting for pullback. It did not pull here, and then it pulled somewhere here. So if this is 50% from this leg to this leg, from this leg to this leg, it did not pull 50%. That means that this is one leg still. That is why if you push like this, this will become a structural liquidity. So immediately it is taken, the market taps onto higher time frame imbalance next to the order flow, because the actual order flow is all of this. So the internal ones are all structural liquidities, but that is why I said you need to learn how to locate 50% pullbacks so that they become your internal structure. Like this, almost pull 50%. So if you move closely, I don't know if this pulled 50%. So this one did not pull 50%. So overall this is the whole leg, but if you use it with other techniques, like as you can see, this was the overall order flow. This last buy before this drop, that was the overall order flow. So we just mark internal legs and see whichever one is going to react from. So as you can see, this one, it tried to react from this, but it reacts from the imbalance here, which is also part of the overall order flow, and then immediately it caused internal change of character, as you can see here. So this high was now protected, and therefore this became now an internal order block that was protected there. So if you sold from this point, you made profit. If you waited to tap on this, you might have not been tagged in, but that is the nature of trade. Not all orders will be tagged in. Now the market causes a break of structure eventually. So it caused a break of structure, and you can see the market moved rapidly without a lot of liquidity. But what happens when it was going back? It pulled back into this overall order flow, but did not react to it immediately and cause a break of structure. This is the last buy before the drop. So this is the overall order flow. Now within the overall order flow, there is always the one that is the most probability, and that is the one located above. In this case is the one located above the PDRAs. This is the last pullback. If this high is taken, this market is bullish. So that is why I'm using it and not using the above one. This is overall, but now we have internal ones. So when I see this, I just mark it from this point. This is the high that should never be taken. If it is taken, this market has turned bullish. So what is the PDRA? The PDRA here is that this is premium, this is discount. So we only look for trades here. So there are two possibilities. Either you could have taken it from this order flow and it would have worked, but you see, you have to put your stop loss. You have to put your stop loss above here, or generally above here. If you are trading like me, you just know that this is the only law that should never be broken. If broken, this whole analysis is wrong. Again, if you want me to give you more, then I can give you more here. Let me delete this. So you can see the market pushed forward here. I want to tell you how to know exactly where the market should never touch. This market pulled up here, then pushed downwards, then it ranged, and then this candle here, this candle's low was taken by this. That means that if I was taking this trade, I would place my stop loss here, because if this high is taken, because this is the high that caused this break of structure, that means that this is the highest probability and should never be taken. This one, if that is taken, we have a change of character. So that is extremely intense for a beginner, but if you want to learn, you can check my Telegram. Here I provide daily market analysis and order flow very well. I tell you where to buy, where to sell, and then I give it in terms of order flow, like this one. I tell you where the market should never reach, like this one. Also, this one was a buy that we wanted to take, and when market came here, we knew when market came to break even, we knew that this market had turned bearish, and that is why you see it sold from this point just by following order flow. Sorry for that, I'm not feeling well, but I just have to shoot this video. So if you want to learn how we took these trades, like the other one that we took here was this gold. I gave analysis here and knew very well that this is the high. So this is the dealing range, daily dealing range from this point to this point. Now this is internal. So what happens here? The market came from this point, pushed back, and then pulled back again, and then now pushed inside. So this low did not break. Sorry, this low did not break this. That means if this low is taken, this thing is going to buy. But if this low that failed is taken, it means that now the momentum is ready, and therefore is going to be taking even this lowest dealing range. So what happened? The market did what? The market instead moved upward, started forming order flow. Market pushed down, pulled back, broke structure, pulled into the overall order flow up here. Now internally it moved upward, moved down, moved upward. This is the break of structure, so this high is protected. You can enter here. Now there was this movement here, there was this down movement, up movement, down. This high is protected, and that is why you see we entered down here and the market kept riding downward. If you want to learn how I trade order flow only, that is what I trade, and understanding where the market is going to move from a daily perspective to a lower time frame, you can join this Telegram. The link is in the description. So let's continue and finalize this video. So when the market tapped on this, last candle, that is the most significant of all, what happened? Immediately it reversed. This is the last candle that should never be broken. So if you place your stop loss above here, if this market drops, if this market passes this particular area, it means that this market has turned bullish. So I would be looking for sells. Now this would be my order. I would be looking for buys rather. So this would be my order flow, and therefore I'm expecting this low here, this last candle, not to be tapped. So those ones I'm giving really advanced explanation. If you want to learn them at individual level, maybe pullbacks, just check in this channel. If you're going to find a video that is explaining valid pullbacks and how the market moves from a higher time frame perspective. So the market tapped here and immediately it caused a break of structure, and that was very rapid. You could hold more because the market was selling. Now it caused a break of structure, did some complex pullback, and then what happened here? Let me explain this. What happened here before I explained using order flow. So the market caused a break of structure, as you can see. Eventually market broke structure here because it closed, but also wicks are used, by the way. So market pushed upwards, pulled backward, then pushed again, causing another breaks, and then this leg pushed but never broke this leg here. That was the last pullback, so it was broken again, and that is why when it was broken, the market was supposed to continue downwards, but eventually it broke this. So this high, this market was still high, was still moving upward. So until the pullback started, that means that this is the last candle here. This is the last candle here. So if you check, this candle was broken, and what broke this candle? This was the range, and then this is what broke this candle. So you only wait for this candle to be broken and the market to turn bearish again. When this market took this, we had to wait for it to be broken down here or up there. So when it was broken up here, it was now good to know exactly where the market should be breaking again, so that the market can have internal change of character. So we wait patiently. This would be overnight, and then when the market opens at London, immediately the market broke this, and therefore we were back to sells again. So what broke this, if I may ask? What broke this is, check here, this candle here is the last high. Now people mark this as the last high, yet this is not the last high. If this high is taken, the market already turned bullish long time ago, because it was broken here, and therefore which one took charge? This red candle. And then this red candle, as you can see, it had the inside bars. Those inside bars are the last pullback before the market changed the character. So it is those pullbacks that broke this lowest point. So this was a range, and then a break. So what broke this thing? The last high that broke this is this. So if this is taken, the whole of this market is bullish again, and therefore it needs to be respected. So that is how you look at candle by candle to know the high, especially when there is range like this. If you see inside the bar, those ones are the last pullback before the range. So by the time the market takes this, if market takes this high here, it will eventually take this one. So this confirms that now the market has changed the character. The market has changed the character, and therefore will be buying. That is extremely intense, but I need to explain to you so that you can have precision entries. So if this is taken, that is a change of character. So like I said, this is the last candle. This is the last from this point. This is the last candle that if broken, the market changes to. I would have been very keen. I'm just explaining this first because I'm on a video. So it is not this low, it is this low that should not be taken, because now the market was still bullish. So if this low is taken, because this one has already pulled upwards, if this is taken, we are going for a sell. So if you are in this market and you want to keep capitalizing on this movement, you place your stop limit, your sell stop, sell stop somewhere here. If this is broken, the market sells, and then you give your stop losses here. If that is broken, that is how it should move. And that you can see the market came back to it, respected this zone and sold. So eventually this is the correct order flow again, but now you can have your stop loss. You can have your stop loss somewhere here if you want to be more precise. That is where your stop loss is if you are swing trading. And then from this order flow, let me delete this other one. From this order flow, you can have your order block. Where is your order block? High probability order block. High probability order block is somewhere here. The market tapped on order block and on fair value gap, and then it moved. So guys, I'll have to stop this video here. So check your market. I'll do part 2 of this video.